welcome back. We continue with the gauge, and I will save some time later. Some of the slides have the gauge code, which you have seen already, so I think we still make everything in time. So here, right, we have the variance equation, which for a gauge MS says that the sigma squared t minus 1 can be modeled as having m lags in the squared return residuals of the past. So the first lag is t minus 1, and then t minus 2 up to t minus m. And then also an autoregressive part of sigma square itself, so sigma squared t minus 1 and then minus j, and j can have up to s lags. Good. So bottom line, it's a parametric model. Why? Because we see alpha 0, alpha I, beta, j, these are all parameters. It's a model because we have here a variance equation and a mean equation for the armor, and applying MLE, we can estimate these parameters. And in the Python focus session, I think 2 weeks ago or last week or both, you have seen that. So this is a thing, it's too small for me otherwise. Okay, so here's something you have seen in the Python code, but I just want to talk about that once myself. So here's an armor PQ gauge MS model. We assume that we observe a time series. I call it RM. Yeah, M stands here for market. And I want to learn the parameters by maximum likelihood estimation. So standard way to go is to assume that the prediction errors are drawn from a Gauss distribution. That makes the log likelihood have this convenient shape here, that I have minus 1/2 log 2 pi minus half log sigma squared t minus 1. Now you see the sigma squared t minus 1 needs to be parameterized. I do that using the gauge MS. And then in the likelihood it continues minus half epsilon square. So I need to parameterize the epsilon. I did that via the armor PQ for the prediction. So the epsilon is here the realized return minus my armor PQ prediction. And then I divide the prediction error squared divided by the variance again. I talked about that one. I like the indexing here, that's why I use it like that. It highlights again that we're looking here, because it's the sum over t, so we look here at the probability of having observed epsilon t, and we evaluate that according to the ex ante variance, so from t minus 1 to t, and the ex ante prediction, which goes in here. Okay, otherwise, just one function depends on these parameters. I can maximize that function. Good. For the initial variance, because the variance equation is like a recursive equation, I need a starting point, different ways to go. One could be sigma squared at 0 is the unconditional volatility, the unconditional variance, or you see in the code, I just, you could set it to 0, or we will see how I did that in the code. So there are different ways on how to handle the very first variance. As t goes to infinity, it doesn't matter which approach you take. Yeah, even if t is not infinity, but 1000 or the like, it doesn't matter. It's just one variance measure. Now I want to talk about this this Glossin, Jaganathan, I forgot the R, gauge. So this allows us to capture skewness. And the way to do that is, it's like a gauge. Here it's 1, 1, so I have 1 epsilon squared residual, 1 sigma squared t minus 2, that's 1 lag in my sigma square, t minus 1, and you see what I'm doing here is I'm adding another parameter theta 1, which multiplies an indicator function. So the indicator turns 1 if the condition is fulfilled, which is the previous return shock was negative. So think about if the theta is positive, it would mean that if yesterday's return innovation was negative, so I exaggerate, I had a crash yesterday, then the variance for today should be larger, if the theta 1 is positive, relative to if I didn't have the theta in my estimation. And since we only apply it for the relation epsilon smaller than 0, we capture that skewness. That variance shoots up, increases in times of negative return innovations. And there's another way to do that. It's the e-gauge. I work with logs here, and I condition on the value of the eta. And I have another expression here, which is known in closed form. I didn't have it in my slides because we will work, if anything, always with the t-gauge. It has been shown in research, in papers that did run horse races, that the t-gauge is easier to work with, and its outcome, its prediction is slightly more accurate. So where am I here? Okay, this is the code which you have seen, I believe. Can you just confirm? At least some code you have seen for the gauge, right? So I then will save some time, because I think you've seen this IPython notebook where this is from. There's also the 2-pass estimation. If I have time at the end, I go through that again. But I want to make sure I have enough time for the Kalman filter. Okay, so applications to risk management. I need a time series in order to work with the gauge. Also, if I want to compute risk factors, I need a time series of the risk factors. Now, it's kind of straightforward to get risk factors for tradable assets like equity, currency, futures, bonds, options. It's difficult for OTC, so this is over-the-counter. So these are assets which parties agree upon a price, but it's not on the exchange, so an external person can't see what did they agree upon. So there it will be difficult to properly estimate vol and therefore compute value at risk. But let's see how we could estimate risk measures if we had a time series. So we have again our model return in t+1 is mu t plus epsilon t plus 1. Now epsilon t plus 1 is the innovation in the return in t+1. We think it has two components. One is the actual shock, which is normalized. It's a normalized shock, has variance 1, mean 0. And the scaling of variance is achieved here through the sigma t. So you can think about you're running this ARMA gauge model on RT+1. You extract the mu t from the ARMA. You extract the sigma t from the gauge. And now you can compute an estimate for the value at risk at the alpha quantile, let's say for the next period. So you just take the expectation for the next period plus the volatility estimate for next period, and then you multiply it by the alpha quantile of the eta density. And if you wanted to compute an average value at risk that I haven't yet defined, but I've mentioned you can compute a value at risk for different alpha quantiles. So if you have an average value at risk, it's also called loss given default, but I like average value at risk better. It's closer to the analytics. You basically take the average value at risk for alphas of, let's say, 5% and smaller. And this formula would also look pretty nice in the sense that we simply need to compute the average value at risk of the eta t+1 shock and then scale it by volatility and add the mu to that. And what I have here with green arrows would all be out of sample. Yeah, so let's say out of sample is tomorrow. Now my day is done, trading day is done. So I would use all returns up to today to estimate this gauge. In the ARMA model, then I have my forecast sigma t for today to tomorrow, and that I use to compute the value at risk, which would be my value at risk as of today for tomorrow. Yeah, so I can go into trading day tomorrow, and I have my value at risk telling me it should not get worse than this loss which I've just computed with alpha % probability. So what I could also do, since x are my risk factors, I So let's say, go back to our stress testing example, we had options and we had two risk factors, the underlying and the implied vol of the option. So let's say I have 1,000 different, I have options on 1,000 different underlyings. So I have 1,000 underlyings as risk factors, I have 1,000 volatilities as risk factors. So I could run an armor gauge on each of these 1,000 stocks and even on the 1,000 implied vols of options. So I had to run 2,000 arch gauge, which I can do. But what I could also do is I can assume there's a factor structure and hope there is a factor structure. There's a factor structure of my xt plus 1. For example, a few PCs, that's the way we did that. Yeah? If we think about have 1,000 stocks, I could think about these 1,000 stock returns in t plus 1 depend on a few factors, maybe just 20. 20 factors, which could be my principal components of these 1,000 stock returns, and then I have a mapping. I don't go into PCA here, but on our YouTube channel we have a few PCA videos, or check on Wikipedia if you, because I'm using PC sometimes in my speaking, but I couldn't fit it into the program here, so therefore I don't know it, or just feel free to have a look into that. So the B could be our mapping from the PCs back, and what I could now do is I apply this armor gauge on the factors themselves. I do the map, and now the epsilon, it would be idiosyncratic using this CAP-M language, so I could either ignore it, which is not good, but I could do it assuming I have a well-diversified portfolio at the end of the day. Therefore the epsilon should vanish, so you see how economic thinking helps me here. That's this common sense. But if I think that I'm not working with a well-diversified portfolio, I could try to get the epsilon. I mean, I have the epsilon, but try to model it. But if I model every epsilon, then again, I could just have modeled every x. So the dimensionality reduction is really if I can get rid of the epsilon in my modeling, which would work in the portfolio context. Okay, but it's basically just to give you the intuition that you can work with a factor representation, be it a PCA or be it some other method you have in mind on how to reduce the factor structure. You can do that as long as you get a time series for that. It's perfect. Then you take the time series, fit an armor gauge to it, and then using the B loading, you map it back into the asset space risk factors that you care about. And we had done that in the past. For example, we have different interest rates which we care about, and then we take the first principal component. It has an R square of 95%, so we ignore the 5% epsilon, and then we run just one gauge on that PC1 and map it back to all 10 different interest rates. So that is one typical example. Good. What I now want to talk about is the stochastic volatility model, also called SVM, but it's not the machine learning SVM. So it's the stochastic volatility model. So there's a very interesting section because it captures a lot. It basically introduces you to state space modeling, which is very famous in engineering, in finance. The entire neural network literature can be viewed as a state space system itself. What we do is basically we have an observed quantity, and it depends on something which we are interested in, but it's not observed. And we want to learn, based on the observed quantity, what was hidden. So these hidden variables we want to learn are called hidden or latent. Latent means unobserved. So typical idea is, this is how it started. You shoot a rocket, or you have a self-driving car, and you don't know where's the car right now, so you have a few sensors, and the sensors record the position, but the sensors don't have perfect accuracy, right? And therefore, based on information a sensor gives you, you want to extract what's the most likely position, and how certain am I? And that has been brought to finance as well, around early 2000. So we will use that in finance. We will observe realized returns, and we want to learn something, either expected returns or volatility. I will talk about that. I start already to mention now, this filtering works very well if the hidden state affects the first moment. Yeah? Because it's like with the car. Where's the car? It says the car is just next door. So in expectation, it's somewhere close to next door. It gets more difficult if I try to estimate the second moment. I will show you in the equations. It's basically not possible unless you do a bit of transformation. And I have an example for that. Okay, now there are different filters. The best known filter is the Kalman filter. So every engineer you come across, they talked about the Kalman filter. And we will apply it to the stochastic volatility model. Okay, so let's just do it. So, first I want to talk about the univariate stochastic vol model. Now that's the second model class next to Gauge. Gauge is one. You remember, the sigma square of Gauge depends on the epsilon square, which is the return innovation squared, plus some autocorrelation in the sigma square. So then clever hedge funds asked if the Gauge was correct, it would mean my volatility moves according to return shocks, because that's the Gauge model. But if that's the case, I could hedge my volatility portfolio, let's say an option portfolio with just stocks, because stocks are driven by epsilon. So I just square it, and it should be driving my volatility innovations, which are basically prices of options. But this doesn't work. At most, 20% of the variations in volatility can be traced back to innovations in the return itself. And therefore, there's a second class of models introduced. And that is the one which has been used in financial engineering. It's used in option pricing. It's used in portfolio management. So it's kind of used wherever you do analytical calculations. While the Gauge, on the other hand, has been used in financial econometrics. Yeah, you need a quick estimate for vol, you do the Gauge. But if you want to do some computations with it or price options, you would go with another model class. And here's the simplest of that. It's univariate stochastic vol. So let's see what it is. So if you want a picture, what we try to do is we have these realized returns in blue, and we try to filter out some red line. So red should be our variance that we want to filter out based on realized returns. So you see what it says here. It says RT is assumed to be sigma t times, now I like the Greek letter, zeta, I believe, zeta t, and zeta t, or zeta is a Gauss distribution, mean zero. So first thing you note is the mean of R is 0. So therefore it's important that you are demeaning the return. Good. So you lose information about the mean, but we don't care because we want to get information about the sigma t anyways. Now the sigma t is unobserved. It's multiplicative to the zeta t. What we observe is just the product of these two things. That's the demeaned return. Now we make a model. The model says, let's assume the sigma t is a constant sigma bar times the exponential of 1/2 times ht. So since sigma t is unobserved, ht will also be unobserved. That's our hidden variable, yeah? Because ht here is the driver. Because ht will be hit by shocks, it then translates into the sigma t, which then translates into the RT. So we build a model for HT, and we say HT follows an AR1 model. Yeah, so it's an autoregressive order 1, and it has its own shock, and it's a Gauss shock. Now both of these equations together is a state space system, because a state space system consists of, I think I should maybe keep working with the PDF. It's okay. A state space system has a measurement equation and has a state equation. So the measurement equation is what you measure, RT. And it has a state equation which is a model of how the hidden state variable moves across time. So kind of in rocket science, I could have RT is the measurement of the position, and HT could be the real position of the rocket, yeah, or it could be the speed of the rocket, whatever is kind of important. In our case here, it will be the volatility, HT. So if you look at that carefully, you see that, what do we see? First of all, sigma upper bar has the interpretation of average volatility, roughly speaking, yeah, because H, you see here, it moves around 0, because phi 0 is 0. So therefore, on average, H would be 0. E to the 0 is 1. So therefore, on average, sigma t and sigma upper bar, they would coincide. So therefore, you see sigma upper bar would be like our 20% number, and then we are deviating from it by H. So H is this deviation from the unconditional mean. Next thing you see, H has its own shock. Therefore, you now have a return shock, zeta, and you have a volatility shock. It shocks H, and then H deterministically goes into the sigma. Now that is interesting, as I said, for option pricing, because we know volatility has its own shock. You can also trade volatility directly, so you want, in a financial context, if you don't just want a vol forecast, but maybe you want to use that for option pricing, you really want another shock for volatility, which is not the return shock. Good. So the question becomes, how can I estimate now the HT? Well, I cannot apply OLS, because in OLS I regress RT on something. This will not work here, because I don't observe anything which I could regress, so this doesn't work. I can also not apply MLE, maximum likelihood, because HT is not observed. And the likelihoods you have seen so far in the course have a feature, we called it X, which is observed. And then I could condition on X is observed, and only epsilon was random, and write down the likelihood for epsilon. So here it doesn't work. So you see I cannot use MLE either. So you see why the gauge is so beautiful, because it's just easy to implement. Here we have to use more complicated methods, and I take the easiest one of the complicated ones, which is the Kalman filter. And it's a very nice intuition. It's a tool which generalizes your knowledge across different fields, so therefore it's really worth doing that. But before we do that, I want to highlight HT maps into sigma t, which is the second moment. And it's very, very difficult, if not impossible, but let's say difficult, to filter out a second moment based on realized returns. Now, there has been a finance paper was written in 1997 by Harvey and co-authors, and they looked at currency, I believe, futures on currency. And they wanted to estimate the volatility and check is there a factor structure in the vol. So, and they came up with a clever transformation. And you kind of see that here. So I do it on the board since I think it's very clever. And it's for you motivation to try to be clever. Don't be afraid, right? Just try to be clever. Sometimes clever will not be accurate, but it's okay. Sometimes it will be. So you see what they do is they have RT here equals, if I write down everything as it is, we have sigma upper bar. The 1/2 is just for convenience, so you will see in a moment why. Eta half HT, this will be my sigma t, and now I multiply that by the zeta. Okay, the zeta is assumed to be Gaussian. Okay, so I cannot use a filter because H is in the second moment. Because if you compute the density, it will be Gauss, centered around 0. And what's the variance? It's e to the 2 times the exponent, so EHT and there's a sigma upper bar power 2, right? That's kind of the density. And take away, you cannot filter the H if it shows up in the second moment. It needs to show up here. Yeah? And intuitively kind of makes sense. The way we compute returns, expected returns, is always, we go for the first moment based on realized moments. But then these guys, what they did is let's say, well, let's just relax and let's do a transformation. Huh? We're just squaring the left and the right. Okay, RT square equals sigma bar square d to the ht times the zeta square. Okay, that seems okay. And this is positive, 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 positive. Let's take the log of that. Yeah? So you have the log of RT squared equals the log of this one plus, and now suddenly this guy comes down, plus ht plus the log of this one. So, observed by simply transforming what I observe, and now suddenly what I care about is in the mean. And now I can use filtering techniques for that. Now, in German we say das Haar in der Suppe. Yeah? You can say, well, but what is the density of this guy here? This is a second order problem. Right? Because this is an assumption anyways, that this guy is Gauss. So we talk about how to handle that, but yeah, we will have some approximation error there. But it's much more important that we found a measurement which depends on something we care about plus a shock. And I'm introducing this Kalman tool using that application. Yeah, it's a bit more of a complicated application because at first it goes into the second moment, but I think for the industrial engineers it's really nice to see that with a bit of manipulation I get a structure which I want to have. And this is the structure that Harvey then did suggest. They simply transform the measurement into ln RT2, as I did it on the board. They have the log sigma upper bar squared, which I also had. Then they have plus ht, okay, that's the volatility, unobserved. And now they have another shock. So the log c squared t, Harvey kind of shows it can be approximated by a Gaussian, mean 0, that's not true. The mean is minus 127, but he puts that out, it's a constant. So you can either have it in here or you just put it out, so he puts it out. Therefore then the epsilon is mean 0, and the variance of this chi square would be pi square half. We don't have to do this derivation. Yeah? He just did it, it's in the appendix of the paper. But the important thing for us is now we have a more textbook-like state space model, because we have a state which is unobserved, it's the H, and the H is going to affect the first moment of something that we measure. And we measure here the log of RT squared, because if I measure RT, I can always measure log of RT squared. It's no problem. So after that transformation, we are in a case of our second moment variable goes into the first moment, because now we also care about log R squared. And you know from the arch-gauge, if you square the epsilon, you're going into the second moment space. So therefore, intuitively, you also kind of see here that a noisy observation of the second moment has the information of the true second moment. Although H is not the second moment, but it's driving the second moment. But then you have some noise. And the idea of filtering will be filter out the unobserved variable ht by just observing log RT square. Good. If you open up a machine learning book, let's say 70% of the book, so maybe chapter 10, if there are 16 chapters, it talks about something like expectation maximization, and what we are talking about here is an application of that. So it's very general. Now, but we go by application first. In our application, let's first check the parameters we need to learn. We need to learn sigma upper bar squared, so kind of the unconditional variance. That's all. And then we need to learn the autocorrelation coefficient of H, and we need to learn the variance of H. So that's it. But we also need to filter the HT. Yeah? So that's what we have to learn if we apply MLE. And let's just go and say, why don't I try to apply MLE? Okay, so we try. So we think about the log likelihood. Now for log r squared t. Let me go back. Here, this looks very much like a Gaussian likelihood that you have seen in the Python tutorial. So nothing else more complicated except for one thing. If I take here the realized squared return minus the prediction, I need HT, and I don't know the HT. That's what I said already 10 minutes ago. So therefore, you see, I cannot apply MLE. That's where I stop, basically. Yeah? Because in the code, I get an error. It says H not known. But I want you to look at that, really, because that is then the motivation of why we need a filter. We will never know the true HT, but at least I can try to get a good estimate of the HT. It's like, I don't know where the rocket was. It might have been plus minus a meter next to what I observe, but at least I have an indication where it was most likely. And this is what we need here. We need to know the ex-ante expectation of HT. And since I'm not really sure that the rocket was at that position, I will have to increase the variance down here in the denominator. And these are the two the two twists we will apply to the likelihood. Now let's take one step back. We again stop here. In statistics, this is called the incomplete likelihood. It's incomplete because HT is not known. I cannot evaluate that likelihood. And then the next step is we are swapping with the expected log likelihood. This is what expectation here means. Mathematically, one can show you can take an expectation of that likelihood with regard to HT. And for that exponential family of a Gauss distribution, the expectation boils down to exactly these two twist points. You have to swap the unobserved HT with its most likely realization. So that's what the ET gives us, because H is Gauss, it's unimodal. So the mean and the mode, they do coincide. Yeah? So we take the most likely value of HT, which we have to learn, /filter. But there will be uncertainty, so therefore we are also increasing the variance. So what the Kalman filter gives us, it will allow us to compute the expectation of HT conditional on t minus 1, and it will also give us the variance of HT. And both of that is needed to evaluate the likelihood. And once this is done, we have a plain vanilla classical standard MLE. Yeah? So in terms of complexity, to estimate a Kalman filter likelihood, it's not that more complex than a likelihood. We simply need to understand how to compute these mean and variance of the latent factors. So why is the variance of ln r squared this thing here? We need to go back always to the measurement equation here. So the variance of the left is the variance of the right. This is a constant. So you have the variance of h plus the variance of this, which is pi square half. And epsilon and h are orthogonal, so there's no covariance. Yeah? So this variance term comes from the measurement equation. Good. Good. So let's talk about then the Kalman filter. So there are a few videos on the YouTube channel. If you want to go, just have a look. I here have a high level. So it was first used for the moon landing in 1969. So it's basically a filter which you observe a signal which goes through a channel which adds noise. And now the goal is to separate the noise from the actual signal. So you kind of see it's used in every signal transmission problem, and engineering is full of it. So the simplest finance example. I did add that over the weekend, so I might have time issues, because when I did time the slides, it wasn't in there. But then preparing again for the class, I wanted to have it in. But there are videos on that which are in more detail if you care. But I want to frame the Kalman filter in the simplest finance example to get rid of the fear one might have of such a powerful tool. So let's assume the return model is like that. R tilde is an excess return, so R minus RF, M is just the market return. So we have the very simple model that the realized return is simply a constant plus noise, innovations. So the constant here would be the equity risk premium, which would be a constant. Yeah, maybe it's 5%. And we know what we do with that thing, right? You have a time series, you know exactly what to do. You take the sample mean of the left-hand side, and that's your estimator for theta 0. You even know this is an OLS or also the MLE estimator, so everything is fine, cool. And now I want to use that and translate that a bit into the Kalman notation, so you get used to the Kalman notation. So in the Kalman filter notation, we want to learn or to filter theta 0 based on observing RMT. Now we have two cases to differentiate. One case is sigma square was 0. So sigma square now in the Kalman filter world will be variance of noise. Yeah? Now it's not information anymore, or it's not unpredictable news. In the Kalman engineering way, this is noise. So if noise was 0, so the sensor is basically perfect, because sigma square is 0. It means the epsilon is 0. We say it's a perfect sensor because just one observation of RMT is sufficient to learn the equity premium, theta 0. So that's the best of all worlds. And in engineering, it would be the world if the sensor was perfectly precise. Now, in the realistic case, even in engineering, sigma square will not be 0, but it will be positive. So therefore, we have a bit of noise. And this bit of noise could be a lot of noise or just a tiny bit. Depends on the magnitude of sigma square. But what do I know? I know that my OLS or the MLE estimator for theta 0 would simply be the sample average. And that sample average would be a random variable, and it would be distributed according to a Gaussian which is centered around the true equity premium, but I will have noise. And the noise depends on the sensor noise, sigma square, but it also depends on the sample size. So if capital T goes to infinity, you see that the variance part divides by infinity, so I have a variance which goes towards 0. So this is the typical law of large number application. For T going to infinity, the sample average is going to reveal my theta 0. So I want to take one takeaway for you from all I've said, which is the blue box here. The Kalman filter solution will basically be something I have in this red box here. So therefore, my punchline for now is that the Kalman filter solution for the hidden state is like the OLS or MLE solution of that hidden state. So that's just as a note, as a punchline note. Therefore, Kalman filter will not be too different than reapplying OLS MLE in the background. But now, what's the difference? The difference is that we apply OLS MLE to theta 0 if we have a lot of t's. But if we have a time-varying state variable, we always have one ht and one rt, yeah? h1, r1, h2, r2. So the difference is here, if we only observe one measurement to infer out the time-varying parameter, then I can still take something of this equation here, because it's going to tell me if capital T is 1, I could still say my theta 0 estimator would coincide with my observation RMT. But I know that the solution is not as accurate, but it's the most accurate. It's an MLE solution. So I know the estimator will be centered around the true one, but I will be exposed to the complete sensor noise, sigma square. And this is where the Kalman filter will come in, because the filter will only use the current observation, RMT, to learn about a variable which is moving across time. So here's the second simplest example in finance. We would have a measurement which is about excess returns, and it consists of an expected return plus epsilon t, noise. And this mu t is unobserved. It's the first moment. And we have a state equation where we say mu t is assumed to be mu t minus 1 plus epsilon mu t. And it's also Gauss. So these two Gaussians are orthogonal to each other. So this is an AR1 process with coefficient 1 here. It's popular. It's also, it has a special name. Local level model. It's called local level model, this entire state space system here. And you see kind of why it's popular. First of all, I do not have to learn the AR1 coefficient here, which is good, makes it easier. Second, often the state variable you want to learn is very persistent, but has little volatility. Therefore, it's difficult to identify. So here we're just imposing the persistence is 1, so highly persistent. And again, like in our state space system, we have this measurement, and here we have this hidden state. And in finance, this would be the risk premium, which we would want to learn. I want to highlight what does the investor know, according to this engineering concept. The investor would have to know the time series of realized excess returns. This is the notation here. So the T says it's a time series. And the investor needs to know both variances. So he needs to know the variance of the system here, of the state equation, and of the sensor. Good. What the investor doesn't know, or the econometrician, is the expected return time series, as well as both innovations. Good. I'm going to highlight that because when we apply maximum likelihood and the Kalman filter, we also need to estimate these parameters. And estimating these parameters makes working with the Kalman filter be not as pleasant as it could be. Therefore, I wanted to highlight that in the typical Kalman filter applications, the sigma squares would be known. Okay. And here's an example from the local level model, but I have more details on that in the YouTube video. Here I just go and present the punchline I want to bring across. So let's assume we are looking at the market. It has a vol of 20%. So if I go back, volatility of the market, 20%. I don't know what sigma mu is. I just don't know it. So I just assume it's 10% of the sigma. I base that based on some some asset pricing theories, but it's just a theory, so I have no clue. So let's assume it's correct. So what the Kalman filter is going to do, it's a recursive system. So it's going to tell me what is the most likely value for the forecast. But I will have to start and initialize the filter. And the initialization is called expert knowledge. You have that in any type of Bayesian estimation. So we also have it here. Basically here we have a time series, and here we have, let's say this is 0, and this is 1. So what I need is, I need to initialize the filter. So I need to know here, this would be my my expectation of mu1 conditional on f0. And I have no clue what it is. That's why it needs to come exogenously. And here I'm just using 5%. So how do I know? You open a textbook or ask GPT, what's the equity risk premium? And most likely it says 5% or something like that. So I use this prior information. So let's say it's 5%. But how certain am I? I'm not really certain. Yeah. So I need another assumption on this concept. How certain am I? How precise is the 5% estimate? Because keep in mind, the equity risk premium will be time varying. Yeah, it's a random variable. So therefore, here I take this agnostic view. I say, which is typical for, it's like the Socratic way. Yeah? I say, I know nothing. So what I therefore say, I say the variance is e to the 12. So maybe I make a second graph for that. So I have a second graph. It also has 0 here, 1 here, and here I now want to plot the variance. So I say here, I have here the variance of mu1 conditional on f0, and this is my e to the 12. So just a very large number. So what I'm basically starting with is with an uninformative prior. Yeah, I know that the true mu1 is a random variable. That's the equity risk premium from 0 to 1. It's unobserved. So therefore, as of time 0, as of f0, you can think about, I assume it follows a Gauss distribution. And it's centered around 5%. But it has a very wide body. Yeah? That's the e to the 12, the variance. So it's basically like a uniform. So I basically say I know nothing. So that's my prior I'm starting with here. And this is expert knowledge. You are different experts, you have different opinion. Yeah, this is fine. We see later a picture. As t progresses, the initial expert knowledge will have little impact on the final solution. But for the first few time points, it will have an impact. So therefore, try not to be inaccurate. This is already something extreme here. Now I assume in t equals 1, the first observation comes in. What do I measure? R1. So I know, maybe I make another graph. I'm observing. So here I have 0, I know nothing. Here, this is my measurements. Here's what I observe. And I observe RT. Yeah? So here I observe a return. In my example, 20%. Good. And what the filter wants to do is, it wants to update this density using the new information. Something in machine learning comes across all the time. If you open the Bishop book, kind of one of the Bibles in machine learning, it's all about Bayesian reasoning. You have some information of a density before you see data, new data comes in and you update. The same thinking comes with the Kalman filter here. We observe a 20% return and we ask ourselves, was that a good prediction of 5%? Or maybe it should be a bit higher. Yeah, most likely not lower, because 20% is above 5. But how much higher? And this is exactly then the Kalman routine where Kalman solved mathematically what would be the correct amount of update. And so here it then turns out, if we make the update, we are now computing, I use the same graph, we are now computing mu1, so again, the value of the equity premium in time 0 and time 1, but now we condition on f1. Because in f1, I have observed here R1 being 20%. Yeah, this is my R1. And if you follow the Kalman filter, and this is just high level for now, to make you see the big picture, what will happen is Kalman filter will then say that we should update this density here. How should we update? Well, you see the mean shifts to the right. It will shift towards the 20%. If you do the math, it will be 19.999. Yeah, so it's not 20.0, but if you just round, it's 20. So we will shift here to 20%, and the variance will be 0.04, so very tight. relative to e to the 12. Yeah? So the new density after seeing the data point might look like this. Expert knowledge, now data comes in terms of the realized return, and we shift the density towards what we see. Now, what really happens is that, and we see it in the algorithm later on, the Kalman filter suggests that you take an average of your prior knowledge and the realized data. So, given that my prior knowledge was basically, I don't have any certainty in my forecast because the variance was e to the 12, it happens that this linear combination will put a lot of weight on the last observation. So therefore, if we work with this uninformative prior here, we are forcing the algorithm to update the first density, so mu1 given f1, towards the data. Okay, and then the next thing we do is, now we need to make a forecast. What's the density for the second risk premium in the second period? And in order to do that, we would have to go and work here with the state equation. Because the state equation tells us how the premium moves across time, yeah, by factor 1, but then there's a shock to it. So the expected change will be 0, because tomorrow's value will be today's value plus noise. Noise centered around 0, so the expected value tomorrow will be today's value. And that is why here you see, if you now make a forecast, where's your risk premium next period, it will remain at the 20%, but you also see, if you look carefully, the variance is rising slightly. And this has to do with, you have uncertainty about the equity premium in period 1 in terms of 0.04, and in addition, there's uncertainty coming in from the shock to the system, which was 0.02. So if you square that, you have 2 zeros and a 4, and if you add these variances, this is what you get. Okay, this was just to put some numbers on, and now we redo that. I skip over that for a moment. Sorry. I put it in, but I want to make sure I go through the algorithm that I want to talk about. So here is now written in the most general way what a linear Gaussian state space model or state space system, SSM, SSS, looks like. Yeah, so let's look at that together here. First, it's called time invariant because all of the parameters will be constant. Good. Let's dive in that. So it's called linear. L. What does the linearity stand for? First, it stands for that the measurement yt depends linearly on the A, on the alpha here. Alpha is the unobserved state. Yeah, so we have yt, I talk about that in a moment, but yt equals a constant A plus B times alpha, and alpha is the unobserved state. So therefore linearity. Now, why is it called, there's a second reason for linearity, you see in the state equation. Alpha t equals constant plus loading phi times alpha t minus 1 is the second linearity, which is different from the first one. So a linear system is linear in both. The state feeds linearly into the measurement, and the state feeds linearly into the state next period. So, now what is the Gaussian standing for? It stands for that both perturbations are Gaussian shocks. Good. So let's look at, again, we have yt equals A plus B times alpha. That's the information. But then it's contaminated by noise, epsilon t. And epsilon t is a Gauss distribution which comes centered around 0. Covariance matrix is H. And the unobserved state alpha, which you see here, affects the first moment. of y. It moves through time based on an autoregressive parametrization plus a Gaussian shock. And the shock has a covariance matrix Q. So the parameters here are A, B, H, C, phi, and Q. So these would be parameters that later on we have to estimate. So what else here? You see, I'm saying yt could be p times one-dimensional. So in general, I could observe p as signals. And they're all informative about the alpha because of the b here. Yeah, so for example, I have the rocket. I want to have at least two sensors because one sensor might break or both of the sensors have some inaccuracies. If I have two of them, I take the average. So average is more robust than just look at one. Or if you think about in terms of the cap M, for example, if alpha was my market premium, I could use realized returns, maybe 1,000 different firms, and they, based on the cap M, shall all depend on the same market premium. Yeah, so I could also estimate one alpha, one market premium, based on 1,000 stocks. So this is possible. Now the other thing to note is I've been written down here conditional on ft minus 1. You usually don't see that, but it's always in the algorithm, so I wanted to have it in explicitly. Because we work with time series data, so we always make our forecasts from t minus 1 to t. So I want to highlight here what is known as of t minus 1. A and B must be known as of t minus 1. But the alpha t is not known. It's the unobserved state variable. It's the alpha t is the realized value of a hidden state which I don't observe. So as of t minus 1, it's a random variable. And epsilon is also a random variable, but this is the noise. So epsilon is the enemy, basically, yeah? Because if epsilon was not there, we had a perfect sensor, and I could simply solve for alpha by saying alpha equals y minus a divided by b. Yeah? But it's exactly that epsilon that I can't do that, and the Kalman will provide us with a minimum variance linear unbiased estimator for the alpha. Okay, the same thing here. Alpha t as of t minus 1 is not known, but I know the coefficients, and if alpha was observed, I would also know alpha t minus 1, but since alpha is hidden, I will never observe it. Yeah? But still, I think it moves in a linear way. Okay. There's just a footnote which I mentioned, and we don't talk about that in detail, but you might wonder, what do you do if you have observed states and unobserved states? But this is too far in the bachelor's, of course, yeah, but just the question might come up. And the point is then, if you have observed states, they are observed, they are known. So you would look carefully at your problem and rewrite that, for example, into the A. Or if the state is driven by something observed, you write it into the C. So just, if it comes across, call me. I tell you once again. But that's the reason why I'm highlighting here the parameters need to be known as of t minus 1. Because if I have observed states and they affect anything of these guys, they will be known as of t minus 1, so I put them into these constants. Okay, but I pretend I haven't said that. So, but I highlight once again, the state space equation is in terms of a measurement that has information of the state in the first moment, and the state itself is latent and has a time series model. Good. And here's now the recursive system for the Kalman filter. We have to initialize the expected value of alpha 1 given f0 and the conditional expected variance. That's exactly what I did on the blackboard. Expert knowledge. Once this is set, we have a recursion to run. And the recursion will be, we are running for t equals 1 to cap t, and now we need to compute different things. So first thing we compute is the learning rate, K. So K stands for Kalman gain. To honor Kalman, it's called K. You can call it, of course, differently, but let's keep just honoring. So KT stands for the Kalman gain. And the Kalman gain gives us exactly the learning rate. So if you see here, by how much shall I update my prior distribution after seeing the data? And this how much is the KT. And formally the KT is computed by, which looks like OLS. If you go through the YouTube videos, I make the connection to OLS closer, but here I just provide you with the algorithm. But you see it's a bit like OLS because you will have here a covariance term and here's a variance term. Now what is the variance term? Let's look, it's B times variance alpha, B prime plus H. So what is that? It comes from here. The variance of Y is B square variance of alpha plus H. Yeah, so you see we are dividing here by the variance of the return, and here in the denominator we are multiplying by the variance of alpha times B transpose. So it's a bit like this guy here, but it's B, not B square. And one can show it's like the covariance over the variance. So that's why it's really OLS logic here, that the Kalman gain basically asks the question, if I observe one measurement error, just one, what can I learn about the hidden state? And that's exactly the Kalman gain. It's the OLS slope, so it's this beautiful relationship of these two things. But here I just care for the algorithm right now. And then I compute the prediction error, because I have my Y, it's the observation, and this is my forecast. Expectation of Y given ft minus 1. Yeah, keep in mind, for the likelihood, I need one step ahead likelihoods, so I need one step ahead prediction error. So how do I compute that? It depends on the model. If I go here, that's why you see why I put in the ft minus 1 here. So what's the expectation of this? It's A plus B times the expectation of this, which if t is 1, so I just enter my loop, it's the expert knowledge, it's the 5%. Yeah, and the expectation is 0. So I could evaluate everything. And now I have a prediction error, which in the previous example was at 20% basically, or 19 point. No, it was not 20%. It was 20% minus 5. So it was 15%, the measurement error. In this example which I had here, let's connect back. Here in this example, I observed 20 and I predicted 5, so I had a 15% measurement error. Good. And now comes the Kalman routine. Because now the Kalman filter says, very classical for these Gaussian shocks, I simply have to update the first and the second moment. Yeah, so the density remains Gauss, but I simply update mean and variance. And here's the updating procedure. So this is called the posterior mean, because it's posterior post after seeing the data. And we always see it sequentially. It's a sequential filter. So after seeing yt, I know my vt, so it's both of them are observed. I now want to update the expectation of alpha t. And here's the update. It's the prior mean plus the learning rate times the measurement error. So you really see what happens here. Before I see the data, in one of my examples, I had a 5% mean, which is this graph here. And now I see the 20% realization, which gives me a 15% error. And now I multiply the 15% by my learning rate k. And the learning rate in that k did divide by this guy here. And I put for the variance of alpha e to the 12, if you remember. Yeah? So I have here e to the 12 divided by e to the 12. It's basically 1. It's slightly below 1 because h is positive, yeah, so it's 0.9999999. So what the Kalman says, in this case, where your prior information is completely uninformative, you are now creating a posterior mean forecast by taking your 5%, but you take a k, which is roughly 1, times the measurement error of 15%. So I basically come up with the 20% mean forecast in the posterior, which I had here. Yeah? And it all has to do with the size of the measurement error, the value of the learning rate in my prior forecast. And you also see that I drew the density tighter. So you see that also my variance gets updated, because the posterior variance is the prior variance, so before I see the new data point, and then times identity matrix, or in the scalar case 1, minus the learning rate times the b. And b again is this loading on how the state maps into the y. So you can think about the learning rate is 0 or positive. Let's say 0, it's between 0 and 1. And you therefore see you are shrinking the variance. And the shrink in my first example was dramatic. Yeah? From a e to the 12 variance, I did shrink it to, what was it? Roughly 20%. Good. So these are now my posterior estimates. So the intuition I like is I still don't know where's the realized alpha because it's unobserved. But at least I know it's drawn from that density here. And the most likely value is the mean, which is this guy. But the precision is measured by the variance of the density. And you see these jargons like more data is better. You have heard that maybe somewhere. You see really more data is better. Because if you have more data, you have more prediction errors, so you can learn from the prediction errors and reduce the uncertainty. Yeah, so more data is better. But of course, it could be that the data is completely uninformative. Which is the case if the sensor is completely imprecise. Then the learning rate would be basically 0, and you don't learn. But still, it's better to have that data. You're not increasing the uncertainty. It just remains the same, or you lower it. And now you need to make a prediction. Where do you think is the latent state next period? And therefore you go back to the state equation. The state equation says it travels according to this. So the expectation of this guy is c plus phi, the expectation. And this I do on the board to highlight. It's kind of true, we have so many boards. So this is what I want. I want to expect, don't go too high. I need to hold that. Okay, need to hold this one. This is what we want. Yeah? So given F1, I want to know where's the state in 2. So what I do is I use my state equation. Yeah? So what's the state equation? It says c plus phi. Okay. Good. So I have c plus phi alpha t plus eta. Okay, and this is all conditioned on ft. Okay, so now I keep going. This is a constant. I wrote on the slides, c must be known as of t minus 1. So therefore it's clearly known as of ft. So this is just a constant I put out. Same applies to phi. What about this guy here? I just leave it for now. But what do I have? I have alpha t conditional on ft. So this was the mean of the posterior, which I've just computed. So this is known. And then the expectation of the eta this one is 0. Yeah? So now you see how we iterate the Kalman filter forward. This is the posterior estimate as of t. I take this estimate, in my numerical example it was 20%. I multiply by 5, I add up the, maybe call it bias, or the mean, I call it bias right now, and then I get my new estimate, yeah? Based on a state equation. Oh no, how do I get up the board? There's a hug somewhere?
Ja, direkt neben ihm, in der Tafel.
Thank you. Oh yeah. Oh, thank you. This is really good. I think using the board from time to time feels like raising the IQ by 5 points, so kind of like to use that. Thank you for the comment. Okay, so you see, therefore, the Kalman filter iterates forward using the state equation, and the variance is also still interesting. Where's the variance coming from? Again, from the state equation, because the state equation, where is it? What do I have? I have alpha t plus 1 equals c plus phi alpha t plus eta t plus 1. So just take what you want, right? And what do I want? I want the variance of alpha t plus 1 conditional on ft, forward looking. And that constant, yeah, so I will have phi times the variance of alpha t conditional on ft, because here I condition on ft, so the variance is also conditional on ft, which I've just computed in the previous step. That's the posterior as of time t. And then just phi squared, and then plus the variance of the eta, which is q. Good, so let's look at that once again. It's a 4-line routine. Now, from a pure algorithmic point of view, you work with a classical likelihood as you've done, or as you've seen in Python. And now you simply include a routine to compute the most likely value of the unobserved state. Wait for the likelihood, you need this guy, the forward-looking one. And then you also need to increase the variance of the estimator, of your likelihood. We see it in the next slide, here. So let's look what the likelihood would look like. This is the expected log likelihood. So the log 2 pi is unchanged. I come to the variance, and then we have here prediction error scaled by the precision, inverse the variance, and then here prediction error. Good. YT is observed, and here these are one step ahead likelihoods, so you see also the predictions are one step ahead, and the variance is one step ahead. So therefore, inside the LG SSM, the expectation of my y conditional on ft minus 1 is then simply a is known plus b is known times the prior mean of the state, which I computed within the Kalman recursion. And for the variance has the age, which you have in the typical MLE, so that's the sigma square epsilon, which we've seen in this class and in other classes. But now, in addition, you are uncertain about the alpha. Alpha maps with b into the y, and therefore the variance of the measurement has these two components. It's the measurement error variance, h, but it's also the uncertainty that you have from where the hidden state has been realized, what its realized value has been. That's the uncertainty of it, and then you scale it by b squared. Yeah? But otherwise, it's a plain vanilla MLE. So it's really beautiful. Of course, there's a lot of theory behind that stuff and a lot of textbook chapters written on it, but this is the essential. Any question? So if that's not the case, then I continue with the case study. And the case study is something you will see in the next problem set. Yeah? So we will work with simulated data in order to control the ground truth versus the estimates. That's something you should really be doing also in the future. Chapter 2, I think, in the Bishop machine learning book kind of says the same. Yeah? You want to test your algorithms with simulated data. So therefore, we will simulate a return series using the univariate stochastic vol model. And you get, again, a code framework. Or not again, you get a code framework, like in the coming problem sets. So this makes it then manageable. And you are filling in some of the blank spots. So based on that simulated time series of returns, you will first estimate an e-gauge. There you use a Python package. And then you will also fit an SVM to that using handwritten code. But you get the frame from us. So therefore, you have now two vol estimates based on the same return data. So you get a bit of intuition also. How much model risk do you have? And then what you do is once you estimate these volatilities, you're going to compute the valued risk and the expected shortfall, so the average valued risk, for both of these estimates. Yeah, so keep in mind, one firm wants to get valued risk correct for its portfolio, and these are two vol models which are proper. So you want to understand first, of course, how to compute everything, and then on a higher level, does it matter which model you work with? And if it matters, can you see why it might matter, and so on. So what I'm now doing, I'm already talking a little bit about the solution, because I don't see you in the tutorial, so I want to take some intuition. So first thing is, we will work with 2,500 observations, and here's just a screenshot of the SVM that we use to simulate. Yeah? So you will simulate a Gaussian shock here, a Gaussian shock there. We even have a correlation between these two shocks, and then you are simulating this entire RT. Good. This is part, like you also see what the problem set looks like. It looks like this page, but we left out inside the loop here. Yeah? So it's not too difficult, but it's a good learning point for you. So you then go back. We are setting the seed, number of time points. We are setting the parameters of the model. And we give you here the comments what to do. And then in your problem set, you go back to the model, you check the nodes, like in the previous slide it does. So here you have to simulate this guy. So this is then what is done here. H true of t equals phi plus H true t minus 1 plus a Gaussian random variable. And then the return will be R equals sigma times exponential half times H true times the shock Xi, and Xi is a Gaussian up here. Yeah, so I think it will be fun to work on the blanks relative to work on everything. And this is what the time series kind of looks like. And this is very realistic to what a real-life risk manager is confronted with. They have these realized returns. They are mean zero right now. And they want to compute the valued risk for next day. Kind of valued risk for here, after the last observation. So what you will do is you apply this e-gauge, the Kalman filter routine. There you have to program up this recursive thing. But here I want to talk about, let's look at a picture here, what we have. Good. So this is the filtered log volatility. Here. So this is the true one that you've simulated based on H true. Yeah, you have H true, you're multiplying sigma upper bar, and then this is your sigma t. And then we did take the log for visualization reasons. So this is the true one here. Yeah, so it bounces around 0.25. So you see there are no jumps, so we can't include jumps in that model. Yeah, but at least we have time variation. And now what you see is you have some dotted lines, and these are all Kalman filter estimates. So maybe we start at the end here, 50 observations. So you see kind of having at least 30 observations, the initialization of my expert knowledge doesn't matter anymore. But on the other side of the coin, it matters for the first 30 periods. So in German, it's called Einschwingperiode. Yeah, sometimes you have heard that maybe. So you need a few observations for the first, for the information that the expert gave on the mean, on the alpha, to not be influential anymore. And the second thing you see is, even though after 50 observations you see the filter is still, the filtered estimate of vol is still different than the true one. And that's just something what life is with financial data. Yeah? It has to do with the 20% volatility we have is pretty large. So therefore we have noisy returns. They are noisy in terms of the HT. And that makes the solution be useful, yeah, because it's not completely ad absurdum, but you also see it's not tracking it perfectly. Yeah? I mean, it gets the slope right, but there's a bias shift here. Yeah? And then here it's too low, here it's too high. But we know, and that's the proof I haven't done, but I knew I can't do it, but it's in the slides, so I have video on that if you care. We know the Kalman filter solution, the dotted lines, are the best estimators, the most precise ones. That's what I know. So, which is good, which means I didn't do a bad job. It's just I'm filtering based on noisy observations, and the noise is substantial. And the three dotted lines, they differ in how I started the recursion. Yeah? This is my expert knowledge guy here. But no, it's not. This is the diffuse one. But you see, I was even scared to make e to the 12. So I just say P1 is 100. So this will be the green curve here. Yeah, so you see it really goes up first quite dramatically. And then I have others where the variance is smaller. Maybe the last graph to look at here. This is the filter uncertainty. So that's the posterior uncertainty. The variance of the state condition on T. And you also see, starting at 10, the initialization doesn't matter. The prior uncertainty I had here of 100 was large at the beginning, but then it also learns quickly. So why we see there's quick convergence in the variance, in the precision, but it still shows we are still off from the ground truth. Good. And then you're going to compute the time series of these volatilities. So you compare the true one, which is red, ground truth, versus what we've estimated. Yeah, and you see here kind of EGARCH, KF implied, they differ. No? So you see model matters, model risk, you have model risk. So, but it's not completely off, but you don't get the same solution for variance. And then you compute the valued risks for these things. And here you will notice that in terms of the valued risks, the models are not that influential anymore, interestingly. So just think about it. And here we now, and you will do the same, you will plot the realized returns and your valued risks. So this is now for visual inspection. You can kind of see if the valued risk was correct, then in 5% of cases we would be underneath the lines, right? And it's not too bad. Yeah, kind of here we are at the valued risk, and here we are beyond it. So this shouldn't happen too often. It happens 1, 2, 3, 4, 5, 6, 10, 12. Here it also happens. So you will also compute a statistic yourself where you compare whether the realized excesses of the valued risk is somewhere in this range of 5%. This is also how you would do in industry, how you would test whether your valued risk forecasts are accurate or not. You would basically check that the worst case realizations are somewhere in this interval of 5%, if it's a 5% value at risk. Right, and this would be your second problem set, basically, to work on that. More information now during the Python session. That is